Business development corporations, or BDCs, offer high dividend yields and have performed strongly over the past decade. But what exactly are they? And is now the right time to invest? Let's find out. So, what is a BDC? A BDC is a type of publicly traded company that invests in small to mid-sized businesses, often through leveraged loans made to companies owned by private equity firms. Essentially, BDCs provide capital where traditional banks might not. Now let's talk about why BDCs can be attractive. BDCs are known for their high dividend yields, sometimes exceeding 8% or more annually. Over the last 10 years, many BDCs have seen solid returns, driven by steady interest income from these higher-yielding loans and the economic growth in the private sector. But what helps BDCs weather financial storms? One reason is the capital structure behind them. They often maintain around 50% equity, which provides a cushion against losses. Plus, the companies they invest in are typically backed by private equity firms, many of which have trillions of dollars in unused capital to prop up struggling businesses if needed. Of course, with high rewards come high risks. BDCs rely heavily on leveraged loans, which can see higher default rates if the economy slows. And as interest rate spreads tighten, meaning new loans might carry lower yields, the margins for BDCs could shrink. This can squeeze profits and dampen dividend growth. Currently, many BDCs trade above their net asset value, or NAV. Why? The existing loans on their books yield more than new loans would fetch in today's market, causing the BDC to trade at a premium. However, those premiums can also mean you're paying a hefty price. So what's the outlook and strategy here? Long-term BDCs could remain solid investments, especially if the private equity pipeline stays strong and default rates remain manageable. But in the short run, it would be a good idea to pay attention to the valuation that you're paying. Paying too much of a premium to NAV could reduce your returns if the market cools. In summary, BDCs offer high yields, strong past performance, and the backing of private equity capital. But they also carry leveraged loan risks and can be pricey when trading at premiums to NAV. As always, do your own research, consult professional advice, and keep an eye on valuation dips before making a move. Thanks for watching. Like, subscribe, and share for more insights on interesting investment opportunities. See you next time.